Hello, and welcome to our Money Facts channel. Today we'll discuss dollar cost averaging versus a lump sum. By comparing your risk tolerance, investment horizon, and ability to stick with a plan, you can decide between dollar cost averaging and lump sum investing. Using dollar cost averaging, is it possible to raise your return rate? Doesn't it lessen your chances of purchasing the market's high, and is it better than making a lump sum investment? What is the efficiency of dollar cost averaging? And now we're getting into a fresh, contentious debate over investing. We'll define dollar cost averaging to show you how it operates. Explain its advantages and disadvantages as well as the reasons why so many people support it. Before we continue this video, please like, subscribe to our Money Facts channel, and enable the bell notification. Dollar cost averaging involves investing small sums of money over time at regular intervals. The method of regularly investing money in equal quantities, regardless of market volatility, is called dollar cost averaging. Investors frequently use dollar cost averaging, for instance, by setting up automatic contributions into an IRA or depositing a portion of each salary into a retirement plan like a 401k. On the other hand, lump sum investing entails investing the entire amount of money currently available for investment at once. In equities and bonds, lump sum investments outperform dollar costs averaging 75% and 90% of the time. However, investors concerned about taking on immediate risk may find that dollar cost averaging is viable. In its simplest form, dollar cost averaging is an investment strategy in which you routinely buy a predetermined amount of a specific investment, regardless of its current price. Consider making a $100 monthly investment in Apple stock as an example, regardless of the stock's current market value. So let's look at how this works. I'll use the S&P 500 as my example in this video, with figures from 1977 through the end of 2016. Let's say Matt has the resources to invest $1,500 per year or $200 monthly in the market. Assume for this example that the man just recently received an inheritance of $8,000. If he were using dollar cost averaging, he would routinely invest a portion of that $7,000 in the market. Assume he invested his inheritance over 3 years. So, on January 1st of every year, he will put $2,000 of his inheritance into the stock market. He will also do this in addition to this $200 monthly commitment. As a result, we made $5,000 in market investments in 1980, 1981, and 1982. In 1980, he switched back to the typical $1,500 annual investments. If he could keep it up until the end of 2016 and equal the S&P 500, he would have a net worth of $600,000 after 40 years. Given that the goal of dollar cost averaging is to avoid making frequent purchases at a high price, you might be asking why he invests once a year. Yes, Matt could do that and invest around $180 per month. He was to make investments with his inheritance and the $200 he had already set aside each month. And if he were to do that for the same 3 years and then continue making investments of $200 each month for the following 40 years, just like in the previous example, he would have a net worth of just under $600,000. But what if he decided to invest all $7,000 of his inheritance? As a result, he would have invested $8,000 in the market in 1980, adding $1,500 from his resources to the $7,000 from his inheritance and investing $200 per month for the following 40 years. He ends up with a net worth of $600,000, over $25,000 more than he would have spent if he had used dollar cost averaging. How is that even doable? Dollar cost averaging ought to lower your risk. In actuality, no. And the justification for that is that the market has the propensity to rise over the long term. For instance, in 1980, the share price of the S&P 500 was a little under $150. Before the 2008 financial crisis, it was valued at more than $1,500 per share, but that was nothing compared to its value of almost $2,500 per share in 2017. It has no value. But why are dollar cost averaging proponents so prevalent? If that is the situation, why are so many financial gurus recommending it? There are a few causes for this, but the main one is that, in this case, Financial advisors don't want to lose a client. Consider what a prospective client may think of their financial advisor following the market crisis. It's unlikely that the new client would be particularly pleased if they had made a lump sum investment on October 9, 2008, immediately before the crash. The advisor's reputation would suffer, as their qualifications result, so you better believe it. Friends of the customer would learn who that individual was and their qualifications as financial advisors. We wouldn't do that. Therefore, I can appreciate the advisor's point of view. Even though dollar cost averaging doesn't always pay off in the long run, it has advantages. That does not mean that no one should make that decision. Make use of the dollar cost average. If you believe that investing all of your money in the market at once is too dangerous for you to handle because it is likely to fail in most cases, even over the long term. When given the option to invest or not, you should always choose the option that led you to make the initial investment. Furthermore, decreased cost averaging can prove profitable for a short time. For example, Matt would still have a $6,000 inheritance and be able to invest $200 of his own money each month if he started investing in 2007 instead of 1977. From around $1,580 in 2007 to about $1,312 in 2011, the market fell dramatically before gradually rising again. Matt would have a net worth of $15,000 if he had invested $7,000 in a single transaction in 2007 and made $200 monthly investments until 2011. However, if he used dollar cost averaging and put $1,500 into the market each year, he could build up a net worth of $28,000 in addition to his typical out-of-pocket expenses. As a result, it might help you in the short term. However, you should be aware of a few things, mainly if you only contribute a small amount of money, such as any fees your financial advisor may impose. You won't be able to fully benefit from dollar cost averaging if your advisor charges a fee, say once a month. Even though it can't answer it in this more broad video, it is evident that you should check it out for yourself. It might do more harm than good if you only donate $40 or $50 a month. So, how effective is the dollar cost average? In most cases, it doesn't, at least not over time. From a purely analytical perspective, we demonstrated various situations where it might be profitable in the short term. And mathematical basis, particularly if looking at a period when the market wasn't performing well. Furthermore, as we demonstrated, purchasing at the top of the market does not guarantee that your risk will decrease in the long run since the market tends to increase. Consequently, where is the current market high? Although it might not be for a few more years, it does, at the very least, lessen people's perceived risk level and invest easier emotionally. Due to this discrepancy, investing in the first place will always win out if the decision is between investing and not investing. The video has come to an end. Please give it a thumbs up and subscribe to our channel for more great videos. Enjoy your day, and thanks for watching.